Guys, welcome to FX Go 3.0 course. I know you guys have been waiting a long time for this, but we've had to ensure that it meets the quality that we expect ourselves to be at, as well as making sure that the contents of this course takes you to the next level of your trading career. Whether that be you're just starting out, you need some help somewhere, or you're an advanced trader looking to find that edge over the market, this course is for you. This course is covering everything from currency pairs to indices to synthetics to metals. Everything can be traded with the strategy within 3.0. Right, so for me, those of you that don't know, I am the GOAT Andrew, otherwise known as Andrew Walker. I've recently moved here to South Africa from the UK. I have a business management degree that I got in the UK when I moved there. I've been training for 4 years. I joined FX Goat as a mentor to help with their IT and teaching, and I've worked my way up to CEO. So that just shows that anything is possible if you put your mind to it and you have a goal. So my goal at the end of the day was to be someone like I am today, sitting here in front of you guys, teaching you guys, right? Because I believe the ethics of FX Coach reflect with my ethics personally, and that is why I'm here today to bring you a deeper understanding of your psychology, as well as the basics of price action, trends in trends, and how to apply them. Right, so the first lesson that we are going to go to is price action lesson number 1, where we focus on impulsive and corrective price action. Right, so the first thing, what is price action? So those that are beginner traders, this is for you. For those that are advanced, just make sure that this is up to standard, that you have a good foundation, right? There's no point in applying the theory of the practical of this if you don't understand the theory. Okay, so what is price action? Price action is the basic movement of price over a certain period of time. And the reason we say a certain period of time is because price action happens on all time frames across the market, from 1 minute to 1 month, right? Everything in between there is price action. And price action is how we trade by looking at the left to predict what happens on the right. Okay, and how do we trade price action? Price action is basically the analysis of price, which gives us entry points into the market as well as exit points. So for those who are thinking, how can I give me both an entry and an exit point? An entry point is basically if you see a price action pattern that gives you a reason to buy, obviously you would buy. And if you hold that buy and you come back an hour later and price has given you a sign that it is looking to sell, you would obviously close that buy, which means it will give us an exit point. Okay, but for this section we are going to be mainly focusing on impulse and corrective price action. Right, so what is an impulse move? An impulse moves are simple. They are large movements either to the upside or downside. They typically move a large period of price over a short period of time. Right, you should see what I mean in the example. Right, so the example on the left, just so you know, this is a 15-minute chart, and the example on the left shows a large movement over a short period of time marked with the number 1. Right, so if you look on the left here, number 1, you can see these are what normal candlesticks look like, and this is an impulse move. Okay, so number 1 I've identified, this is an impulse move. You can see that this is a large movement of price over a short period of time. So if each of these candles represent 15 minutes, right, you can see how small the other candles are compared to this large candle. Okay, so this just shows that price moved from point A to point B relatively quickly within 15 minutes, whereas 15 minutes it took from there to there took a couple of hours. So this is what an impulse move. Right, so if you compare the candlesticks marked 1 and 2, you will see a big difference in size. Candles marked 2 are normal candles in comparison to the impulse marked number 1. Okay, and this is how we can identify price action, right, by understanding impulsive and corrective. So if we know that this is an impulse move, we can then start looking at what happened before the impulse to see if there was a price action analysis that could have given us an entry into this, right, which will go into more advanced stuff as we go on. Right, so the image on the left is the same chart showed on the first example but on a different time frame. Impulse moves happen on all time frames, however they appear much larger on smaller time frames. So for example, the previous picture, this is a 15-minute chart, right? So a 15-minute chart, each candle represents 15 minutes that have passed. So if we look at this is the same impulse move but on a 4-hour chart. So you can see that the movement is still relatively big, right, compared to the other candles. Okay, so this is how price moved over 4 hours, right, and 4 hours consist of many 15-minute candles, right? So it just shows the impulse in there. Again, you'll see a big difference in signed candle mark 2 on normal candlesticks in comparison to the impulse mark number 1, right? So number 2 normal, these are all normal. This here would be another impulse because it is bigger than the previous candles, right? So this is a large movement of price over a short period of time. Okay. Then we need to understand a corrective. So just like we've spoken about impulses, there is corrective price action as well, which we consider a corrective move. Corrective movement is also known as a pullback. So this is when price takes a break. It is a period after an impulse move where price does not move in any direction, giving us sideways movements. Okay, there's an example coming here. You can see number one, we have an impulse. Number two is what we have is the correction, then an impulse and a correction. The image on the left shows the market impulsing, followed by a correction mark 2, followed by another impulse mark 3. So this is why I want you guys to know the basics of impulse and corrective, because it happens on a daily basis. So if we can get these on a daily basis, we can catch relatively good trades that move a lot in a short period of time. So this will then cater for scalpers, or people that don't have the patience to hold trades for long periods of time, right? So this is a 15-minute chart. You can see the image on the left shows market impulsing followed by a correction, right? So number one, this is an impulse. Okay, we have an impulse, we have a correction. This is basically where price just takes a breather, because if it moves too quickly, it will cause an imbalance in the market. So this is where it pushes down, it corrects, it pushes again, it corrects, and it pushes again. So this is why impulse and corrective is so important, because if we can catch the move at the beginning and it's going to continue impulsing in our direction, we can hold the trade, right? So the market will continue to impulse in the same direction given there is no signs of reversal. And like I said in the beginning, it gives us entry and exit points, right? So if you look at number 2 here, right, we could have an entry on the break of this correction, right? So there's an entry, right? And because we don't see a reversal, right, so it's just the impulse or correction, there is no reason for us to close this trade early, okay? So that is the nice thing about impulse and corrections. They normally tend to happen for quite a while in the same direction, which is really good to trade, allowing us to catch a lot of pips really quickly over a short period of time, right? You should think of a correction as the market taking a break after impulsing. So think about running a marathon. You're going to run, and then you're going to take a break. So you're going to walk for a couple of minutes, and then you're going to continue running, then walk, and then continue running. Same thing like the market, right? What's up, guys? Welcome to TradingView. This is where I'll be showing you guys real and practical examples of the theory that I teach. Before I get into any information, I came to TradingView so that I could illustrate to you guys live why understanding impulse moves and corrective moves are so important. So I've been teaching people now for a year, and I see that time and time again people make the same mistakes, right? And these same mistakes, they are so simple that they can be fixed, but people don't have the understanding of what they're doing wrong. Okay, so the first thing I want to highlight for you guys is people often mistake corrections as a sign of reversal and often end up on the wrong side of the market. So if this is you, where you enter a trade, you're in profits for a short period of time, and then the market goes completely against you, this could be that you are not understanding an impulse move and a corrective move correctly. Okay, so I need you guys to understand that if you're a scalper, this is completely fine, but just understand that you are trading against the market, right? So if you're impulsing to the upside and you're entering sells, you're going against the market, right? So obviously it's impulsing up, you should be looking for buys, not for sells, right? So if I show you guys an example here quickly where price moves, right? So let's say this is a large impulse and price does this. Okay, what a lot of people tend to do is think, okay, the market is finished impulsing, let me enter a buy position. So they enter a buy position, their TP and stop loss is in the right place, right? And they wait to see what price does, and it does, it goes a little bit into profit, right? So it continues with this correction, right, to the upside, because we just impulsed to the downside. So now we've continued with the correction, which is a pullback. And so people, they enter buy, they go into profit very temporarily, and then price impulses again. Okay, and then price does this again. So what do people do? They think, okay, now the price is ready to reverse. So instead of looking for sells, people start looking for buys again, right? But it's just about understanding the nature of the market and how the markets move. Excuse me. So obviously, if the market is impulsing in a direction, you want to be looking for trades in that same direction, unless some of the patterns that we cover in the course are followed by impulses. So I want to be very clear that impulse and corrections are so important, right? And I'm sure a lot of people would relate to what I've just explained, where they see price reverse, think it's reversing, enter buys, they're in profit for very short term, and then price ultimately continues to the downside. Okay, so anyway, again, people here see, okay, price is now is correcting. There could be some sort of candles. They give them confirmation. You've got trends, and they go a little bit into profit, and then price impulses again. Okay, so this is very, very common, right? So like I said, I've been teaching you guys for about a year now, and this problem comes up and up over and over so many times. So I want you guys to make sure that this does not happen to any of the students that purchase the 3.0 course, because ultimately we are here to take your trading to the next level, and just by understanding the simple basics of what I've just explained is going to change your trading game completely, right? So just understand that if you see a correction or a pullback, it's not a sign of reversal. If it is impulsing in a direction, it should continue that direction, unless some of the patterns that we identify later on in the course are present within the market, right? So this is something I just wanted to go over. It wasn't in the theory of the slides, but I just wanted to add it because I felt like it was very, very important, just to make sure that you guys have a proper understanding. Okay, so now on the charts here, I have GBP JPY, where I'm going to be showing you some real life examples of how to trade pullbacks, how to enter from a correction, and so on. So in the market, yeah, I have GBP JPY. This is a 30-minute time frame, and if we, I know I'm going back in time. I'm going to the 27th of July, 2022, so a couple months ago. I want you guys to see that the price, how price has changed. Okay, so if you look at this on the 30-minute, you can see price was obviously bullish, right? And then price made a high, retesting the previous highs, but then fell. Okay, so now this is a perfect example of where people make the mistake. So they look at this and think, okay, price impulse. We now have some sort of level over here, so we look for support, and now let's enter buys. So they enter buys, their stop losses in the correct position, their TP is like, okay, now we're going to make new highs, so let's put our TP, somewhere here, right? And you can see they're going to profit, and then ultimately price reverses. Okay, and this is ignoring which way the market is moving. So obviously if it's impulse to the downside, it should show you that there is a lot of bearish pressure, meaning you should be looking for sells as well, not for buys. So this is where you go temporarily into profit, and then price impulses again, and ultimately hitting stop loss. And then you think to yourself, okay, that could have just been unlucky. So now you see another thing where, okay, I've got a bullish candle, so now I can look for buys again. So what do? You enter buys, you target the previous high, and then you get stopped out, right? So by understanding an impulse and a correction, it should stop these mistakes from happening, or stop you entering the trade at the wrong time, allowing you to be on the right side of the market, right? So if we look at this on a 30-minute time frame, if we look how prices move, so again, we've made a high, we've impulsed to the downside, we have corrected, right? So this is a pullback, and now we've impulsed again, and now we have a correction. So for me, I would identify this as a correction, right? Which means that we could get an entry for sells on the break of this. Okay, but the nice thing is this level that I've drawn has given us an extra confirmation, but we'll get to that in future stages. So if you look at this, right, I'll show you an example. If you look at it, we have the impulse, we have correction. So like I said in the theory, where price doesn't really give us a direction, but rather takes a breather. So if I just show you this, you can see we have the impulse, we have the correction, and now we have the impulse again. Right, and the simpler you keep it, the simpler your trading will be, and the more profitable your trading will be. So there's no point in overcomplicating it or anything. And if I had to look at this, we could take an entry on the break of this correction panel, meaning we could either go to a 15-minute time frame, for example. Let me just get back to where price was. Right, over here. Right, we could look at this and see, well, okay, if price breaks this low, it could give us an entry, or if we form this flag and we break the flag, it gives us an entry. So just by understanding that this is a correction, we have two entry points, right? So this would be entry number one. This would be entry number one, and then entry number two would be on the break of this low. Okay, so you can see by us understanding this, it's given us two entry types, two different types of entry, but at the same time it's almost different, right? So just by understanding that, well, when a correction comes, it's just about waiting for the market to do what you expect it to do, not what you want it to do. So if you expect the market to push up, you wait for it to push up to then give you that, okay, what I've predicted is right, I can now take a trade from this point. And that is where a lot of people make mistakes. So again, we have two types of entries. We could enter on the break of this channel that we've identified. So this is the impulse, the correction. These are what we identify as channels. So if we break this channel, right, that gives us an entry for a sell, because the overall direction is sell. We've just come from the top, so now we are currently falling, right? And entry number 2 is if we break the low of where the impulse, the correction started, right? So obviously price pulled back, pushed down, and now it corrected, and by doing that it gave us some lows. So if I do this for you, right, you can see now that if I mark where price is, this is the low that we are looking for, right? So if we break this, it would give us an entry for sell. Okay, I wouldn't take an entry at the top of the channel, because at the same time we don't know where the top of the channel is. The top of the channel could be a bit higher, could be a bit lower, it could go for a deeper retest or not. So we just wait and we see ultimately if we break below. Okay, so if we do this, we can see here immediately we get a bearish engulfing, we break this channel, right, and we take out the low. So this single 15-minute candle could have given us 2 different types of entry. So you could have had a pending order or a market execution if you're watching, giving us an idea that, okay, the price will continue selling. And this is the very, very basics of understanding impulse and correction. They play such a vital role in how you as a trader trade, so that you are not caught on the wrong side of the market. Okay, so now let's see where GBP JPY takes us now. Right, and I'll try and give us a real life example of what I'm looking for. So right now you can see we've impulsed, and now we are almost correcting again. So if I draw this as a correction, right, this will give us an idea that, okay, if we break this, for example, we could now look for sells. So I'll play this. So keep playing it through, keep playing it through. You can see we still haven't, again, we're moving very, very sideways. Okay, so again, it's just about waiting, and you can see price is now within these 2 channels. So again, corrections can happen over days, couple of hours, couple of minutes. So for this example that I looked at over here, this was a couple of minutes, maybe an hour or so, just correcting. So from 10:45 to 1 o'clock was when the correction, and then we had an impulse ever since. So there is no time limit or criteria that a pullback has to meet. It can be over a period of, like I said, a couple of minutes, a couple of hours, a couple of days, and so on. So let's just see how this continues playing. Right, so again, it's not really giving us a direction. It is more of a correction. So there's no real direction. It is moving to the upside, but it's not impulsing, or it's more of a correction of nature, right? So if we look at this, we've now broken. So now if we break, we're obviously looking for sells. Why? Because we've just come from an impulse. So stop loss above, TP1 at the start, and now we can see where this trade will take us. I'm just going to speed this up. And you can see just like that, by identifying that channel, on the break of that channel, we have now hit TP, right? And that is literally just me using impulse and correction theory to apply this. In future stage, we will go into a lot more depth of how to trade impulse and corrective using other confirmations to enter a trade, but that is the pure basics of an impulse and a correction. Again, this theory is very, very important, because people will make the mistake of entering buy positions when ultimately you're trading a pullback and you're holding that buy expecting to swing it to the upside, when you're in profit for a short period of time before ultimately price reverses on you. And you can see the impulse moves are relatively the same size as the correction, should I say. So if the correction is this long, the impulse, what we call is the 90% rule, will complete from where the correction started. Okay, so this is ultimately where you would put your first take profit. This is a real life example. I have not prepared this. I have just gone through this with you now, showing you how powerful the theory of understanding of what price is doing plays a massive role in how profitable you are as a trader. What's up, guys? Now that I've showed you the example of looking for sell after an impulse, obviously if it's impulsing to the downside, we look for sells. Impulsing to the upside, we look for buys. So this example, I'm going to be looking at NASDAQ and applying the same theory, but now it would be the opposite direction. So now I'd be looking for buys. Okay, so ultimately price has pushed lower, right? And now I'm on a 50-minute time frame, just to make it easier to identify. We can now see that price has impulsed to the upside. So never mind now impulsing to the downside, we've now impulsed to the upside. So what are we expecting after an impulse? We are expecting some kind of correction, right? So if I just had to predict this, so this would be some sort of correction, right? You'll see a lot of similarity in some of the patterns we cover in the course as well, where we consider these corrections. These corrections come in different shapes and sizes, but for now I'm going to focus on the basic ones. And if you look at this correction, right, we could see that this correction actually spanned over quite some time, right, before we got another impulse to the upside. So if you look at this as a channel where price didn't really move, it didn't go up or down, it sort of just moved between two levels before finally impulsing again. So like the same example, we could identify that, okay, there's an impulse, so after the impulse we are expecting some sort of channel, and this channel, like I've drawn, is our entry type. So we have another entry where we could enter buy positions on the break of this channel, okay? And now because the market is impulsing to the upside, we ultimately have the market on our side, so there is no reason for us to close this trade early unless we see a sign of a reversal. So right now price has impulsed to the upside. Let's see how price continues moving. You can see that there was almost another correction, right? So we impulsed. I'm going to delete this now. So we impulsed, there was another correction. Okay, so like I said, with impulse and corrections, after the impulse we always expect a correction, right? So if you look at this on a 30-minute time frame, this will be a couple of candles. It wouldn't be this noisy, but again you can see we have this correction. This candle would have confused a lot of people. It would have faked out a lot of buyers, right? So it's just important about waiting for the close and the break, or a strong push to the upside like we have now. And this would be a perfect example of where we could buy, right? So just like we have that other buy that we entered over here, right? By seeing this impulse and correction, we should be ultimately looking for buys again. So you can add on to this position. So ultimately now you have two positions running that are in profits because you're trading impulse and corrections, right? So again, we have an impulse, we impulse the upside, and now after the impulse we are expecting a correction. So let's see what price does. Ultimately it corrects for quite some time. Okay, it goes in for a deeper correction, and then ultimately pushing to the upside, right? So again, if I switch to a 1 hour, for example, you can see now that we have a correction within a correction within a correction, right? So here we have a impulse, we have a correction, we have an impulse, we have a correction, we have an impulse, right? And now we have a large correction, right, where price ultimately impulsed, it corrected, it did not move in a direction, it gave us 2 points of where we could have entered on the break or the break of the high. Same thing, right? So if we look at this as the high, we could have entered on the break there, or we could have even entered on the break of this channel. So this is entry number 1. Obviously if we break the channel first, that is your entry. If you want an extra confirmation, right, you'd enter on the break of the high. So this would give us something like this. And ultimately it's so simple about understanding market structure, impulses, corrections. You can see just by understanding impulse and correction, this would have got you 1, 2, 3, 4 trades that would still be running, right? So that is the nice thing about impulse and corrections. Again, people make the same mistakes with impulse and corrections to, you know, enter the opposite direction that it's impulsing. So for example, like we've just seen, price impulses to the upside, okay, and now price does this. So people think, okay, price is now gonna sell, we've just impulsed, so now let's enter a short position, right? So they enter a short position, and then ultimately again they go into profits for a little bit, right, because of the part of the correction, and then we impulse the upside. And this is where a lot of people fail and hit stop losses when they shouldn't be hitting stop losses, because you're going against the market. Okay, I'm really hoping that these examples have opened your eyes into another level of understanding how price action works. Okay, price action really does work if applied correctly. So hopefully you guys enjoyed this series on impulse and correction. I will see you guys in the next lesson.